everyone, welcome back to the show. Thanks for tuning in. Hopefully everyone had a great weekend. My name is Mike, this is my whiteboard, and today we're going to be talking about the relationship of two Greek metrics that we look at, and those are going to be delta and Vega. So when we learn about the different Greeks, you'll tend to see some similarities between the two. So when we're looking at delta and Vega, they actually are both metrics that look at either a $1 change in the underlying or a 1% change in volatility. So really it's what is going to happen with the option given a change in a separate metric that we're looking at. And today we're going to be looking at the relationship between these two, specifically with put options and also with at the money and out of the money options. So let's dig right into it. Let's review what delta is and how we use delta in our options trading. So when we're looking at delta, really it's the rate of change of an options price given a $1 move in the underlying. So if I've got a call, let's say I'm looking at a long call, and that call is worth $3 as you see here. If there's a $1 increase in the actual underlying of the option that we're trading, and after that $1 move, my call is then worth $3.50, I know right away that this call option had a delta value of 50. That's because I know that if the change in delta, or the change in the underlying price, is going to change my options price, if this option price changed by 50 cents, it must have had a delta of 50 prior to this $1 increase. Now, if we were to see this as a $1 decrease and it had a 50 delta, then we should see this underlying, or this option I should say, change from $3 to $2.50. Now, this is a good thing for option buyers. So being positive delta, if I'm long this call, is great if the underlying does increase. But when we're looking at it from the flip side, if I was short this option and I was short the call that was worth $3 and it increased to $3.50, that would be a bad thing. So it's really going to depend on whether we're long or short the option and what we want the underlying to do with that assumption. Another way we can use delta is as a proxy to probability of being in the money. So if we understand that the farther out of the money options we look at, there's going to be a lower and lower probability of those options being in the money, it's going to look like a bell curve. And the closer we get to at the money, the closer we're going to get to that 50% mark of the probability being in the money. And the more and more in the money we go, that higher, we're going to have that higher probability of it remaining in the money because it's already in the money. So you can use delta as a proxy to our probability of being in the money. For a quick example, if we're looking at a 1 standard deviation option that's out of the money, a 1 standard deviation option is going to look at a probability of being in the money of about 16%. And if you look at the delta, it should be around a 16 delta as well. And last but not least, we've got a directional exposure when we're either long or short options, and our delta can give us that directional exposure. We can see just how directionally exposed we are when we're looking at the delta. So the higher delta I have, the more directionally exposed I would be, and the closer I am to zero, the less directionally exposed I would be. And it's really important to remember that when we're looking at positive deltas, that would indicate that we have a bullish assumption. And the opposite is true for negative delta. So if I have a negative delta position, that would mean I would want that underlying to go down. I would have a bearish assumption. Because in this situation, if I'm long a call where I have a $3 valued call and it goes up to $3.50, and that's after the underlying has increased by $1, that's where you can see that I would have a positive delta of 50, and that would mean that I'm bullish. So that is a few things that we use delta for. Now let's talk about a few things that we use Vega for, and then we'll tie it all together with some cool relationships. So when we're looking at Vega, Vega is the rate of change of an options price, just like delta, except Vega looks at implied volatility. So Vega is looking at the rate of change of an options price given a 1% move in volatility. So let's look at that exact same scenario. So we've got that same call that's worth $3, but now instead of looking at the underlying's price change of $1, we're actually looking at the underlying's implied volatility move. So let's say that implied volatility goes up 1%. And now my option is worth $3.50. That would also indicate that my option had a Vega value of 0.50 or 50 Vega. That's a pretty high Vega value. That would indicate that it's very sensitive to changes in implied volatility. And when we're looking at options, it's important to remember that when we have long options, we're looking at positive Vega, because if I'm long an option and implied volatility increases, if we remember that implied volatility is just an indication of where the option prices are, so if implied volatility is increasing, that must mean that the option prices are increasing, which would allow me to then go ahead and sell that option out and hopefully reap a profit. So when we're looking at long options, it's going to have a positive Vega, and we're looking at short options, it's going to have a negative Vega. So when we look at Vega, we're really looking at managing that Vega exposure and making sure that, especially when we're selling a lot of premium, we're not exposing ourselves to too much Vega, and we're offsetting that with maybe some positive Vega positions, etc. So we know what delta is, we know what Vega is, but what are some relationships between the two? So the very first one we're going to look at is the relationship between at the money and out of the money options when we look at delta and Vega. So on the next slide here, I've got a sort of a graph that kind of shows you our standard bell curve. And we're looking at just out of the money options. So I want you to envision that we're looking at put options. And I want you to look at this dotted line as the at the money price. Anywhere above here would be our in the money options. And right here we're just looking at going further and further out of the money. So let's first look at delta. Well, if we know that our deltas are going to be right around 50 if we're looking at the money options, of course, if we were to continue going in the money, our delta would increase and increase, because as we know, the further in the money we go, the higher our delta is going to be, and it would be capped at 1.00, where we would be dealing with mostly a short stock position if we were long a put. But when we look at going from at the money to out of the money, you're going to see that delta decrease and get smaller and smaller, especially as we move further and further out of the money. If we know that delta can be used as a proxy to our probabilities of being in the money, and the further and further we go away from that strike price and stock price, the lower our percentage is going to be in terms of our probabilities of being in the money, then that means that our deltas are going to be lower as well. But let's look at Vega and look at the similarities. You're going to see Vega have sort of that same relationship. We're going to see Vega values very low in out of the money options, and you're going to see Vega values the highest with at the money options. So the difference between delta and Vega, if we look in the money, is that delta is going to continue to increase, but Vega is going to actually slope back down as you look in the money. Now, why is that? Well, we know that at the money options have the most extrinsic value, and extrinsic value is going to taper off as we get further and further out of the money, and it's also going to taper off as we get further and further in the money. When we look at far in the money options, they're mostly going to be made up of intrinsic value. There still will be a little bit of extrinsic value, but just like deep in the money options and deep out of the money options, the smaller extrinsic value we have, the less sensitive those options should be in terms of increases and decreases in volatility. If I've got the most extrinsic value here, and extrinsic value is just time and volatility value, then it makes perfect sense that if I have an implied volatility change, it should affect these at the money options the most. So what are some high Vega exposure option strategies? Well, maybe just selling an at the money put, or especially selling a straddle. That's going to have the highest Vega opportunity. So if we sell a straddle in a very high implied volatility environment and we see that implied volatility contract, we should see a pretty large contraction in those option prices that are closest to at the money. So whenever we're looking for big Vega exposure, when we're looking at short premium, you'll normally see the strategies revolve around those at the money options. So just for the sake of these graphs, they're going to be different values. So you're not going to see a 50 delta option have a 50 Vega. They're not going to be correlated in that manner. So it's not going to exactly match. They're going to have different values. A 50 Vega option would be extremely high. Normally you'll see it around between 10 and 20. I've seen it around 15 normally, when you're looking at something like Apple in the 45 day till expiration range. But they are going to have the highest value in those at the money options. So when you're going from far out of the money to at the money, you're going to see Delta and Vega have this similar relationship. They're going to be highest in the at the money options, and then they both go their separate ways as you go in the money. But I wanted to point out this relationship for out of the money and at the money options. Now let's go on to the next relationship, which is the synergistic relationship with put options in terms of Vega and Delta. And this is one of my favorite ones. And it really helps us get on both sides of the winning coin when you're looking at buying options and selling options. So if I'm looking at selling a put or buying a put, Delta and Vega are actually going to work hand in hand to help me become profitable. And when I say that, first you have to understand what these values are going to be doing when we're looking at a long put and a short put. So let's first look at a long put. So if I have a long put, I'm basically buying the option to sell my shares at a certain strike price. So I want the underlying to go down because that would increase the value of my put. So for that reason, you know that when you're long a put, it has a negative delta. It's going to show you a negative delta because it's going to have that bearish assumption. We want the underlying to go down if we're long a put. On the flip side of the coin, if I'm looking at Vega, if I'm long an option, and we know that when we're long options, we have long Vega exposure. If a long put has long Vega and it has short delta, and I know that a short put is just the opposite, what does this mean for me? Well, first we have to understand what we talked about a few days ago in my previous whiteboard, and we talked about the impact on market moves with implied volatility. So normally, when we're looking at implied volatility, if an underlying decreases in price, so let's say an underlying decreases 10% in price, we normally will see volatility increase. So how does this affect these options? Well, if I'm long a put and I have that negative delta exposure, if the underlying decreases, yes, that's going to put me in a more profitable position, most likely, as long as it happens in a timely manner. And if volatility increases and I'm long this put, that's going to also help me become more profitable if volatility increases to a higher rate than the theta decay that I'd be experiencing with that long option. So when we're looking at a long put, these two work synergistically. And also, when we're looking at a short put, it's the very same. So usually, when an underlying increases, we should see volatility decrease. So let's say that same underlying, we saw a 10% reduction in price in, it now has a higher implied volatility, and I want to be a contrarian and short a put into that move. So if I shorted a put into that move into a high implied volatility environment, I would have those long deltas. And let's say that the underlying ended up coming back up those 10% points that it moved down. So it went down 10%, people started to panic, implied volatility increased because people were purchasing options, and I ended up selling a put there. And over the next week or so, the underlying went up 10%, and we saw that volatility decreased. Well, we know that if I'm short a put, I've got a positive delta, so that's going to be good for my position if the underlying is increasing in price. And if implied volatility is decreasing, that's also going to be good for my Vega exposure, because if I'm short an option, I want implied volatility to decrease because that's going to put me in a more profitable position. So this is a cool synergistic relationship between Delta and Vega. Hopefully you've enjoyed this. Let's wrap it up with some takeaways for you. So the very first takeaway is that Delta and Vega are both highest in at the money options, and we're not considering in the money options. They both will go their separate ways as you go in the money, but when we're just talking about going from out of the money to at the money, you'll see both Delta and Vega increase. And both of those options are going to be lowest in out of the money options. But the coolest takeaway for me is this synergistic relationship when we're talking about put options, Delta and Vega. So if I'm short a put, my directional assumption and Vega exposure should work hand in hand to make me profitable faster. And also that's true when we're looking at long puts. So if I'm long a put or a long put diagonal spread, for example, which is a great example of something we might do here, my delta, my negative delta, and my positive Vega should both work hand in hand to make me profitable in the long run as well. So when something increases our rate of profitability, it can also decrease our rate of profitability or make us lose faster. So it's important to be at a comfortable level with these two variables and go from there. So thanks for tuning in. My name is Mike. If you've got any questions or feedback, shoot me an email here, or you can follow me on Twitter at DoTraderMike. We've got Jim Schultz coming up next though, so stay tuned. Hey everyone, thanks for watching our video.
If you liked this video, give it a thumbs up or share it with a friend.
Click below to watch more videos, subscribe to our channel, or go to our website.